Go.
Thanks for tuning into the Mutual Fund Show. I'm Niraj Shah, and today we are going to be discussing, a couple of pretty interesting topics. So one, if you are indeed debt investors, and I know it becomes even more difficult these days than it is in investing in equity funds. If you are indeed debt investors, how is it that you can build an optimum debt portfolio? What is it that you should keep in mind while choosing which part of the debt scheme do you want to get into? We'll also, as our thesis suggested, talk about target maturity funds and the importance of them in the debt schemes. And then, of course, you can choose accordingly. And our guest today who will do all of that, Vishal Kapoor, will be also talking about their NFO, the IDFC Gilt 2027 Index Fund and IDFC Gilt 2028 Index Fund. So he will talk a bit about that. And a bit later on in the show, we'll get in Harshad Chetanwala, who will, of course, give his opinion on these NFOs. And then, as is the case normally on the Mutual Fund Show, talk about one key recommendation from their firm's end and why is it that they're recommending that fund. We'll also squeeze in a question around one key performing or underperforming or outperforming category from Harshad. But Vishal, really good having you. Thank you so much for taking the time out. Hope all is safe.
Good to be back.
The pleasure is ours, Vishal, really. So Vishal, tell us, I mean, debt is a fairly confusing category these days with a lot of changes happening and all the conversation around interest rates, etc. How does an average investor approach investing in debt funds?
So, Niraj, firstly, thanks for recognizing debt as a very large and a very important asset class, because I know that equity tends to almost hog the limelight because it seems to be a lot more action-oriented, etc. But we have to keep in mind that the bulk of investor savings, even today, is in some form of debt. And therefore, the impact that understanding debt can have is far larger in a way that it impacts, your financial outcomes. It's very important to understand debt. Is the first, point I'd like to make. Having said that, it can be a complex topic, which is why what we've tried to do at IDFC is to simplify it as much as possible, and really provide an approach to how you can build a debt portfolio. And the reason I'm saying that is because behaviorally, what we think we see, and a lot of our partners give us feedback, is that 90% of the time that you discuss is about which equity, either stock or fund or what part of the market, and debt is almost like the remaining portion, which is okay. Now, what do I do with this lump sum, which you just put into either a deposit or some form of debt fund, and what's the correct strategy for now? Now, we do think it's very important, therefore, to look at debt as any other asset and therefore have an allocation. And that's what we think is a better way to approach it.
Yeah. So I think I was looking at the presentation that you've sent across as well, your team sent across, Vishal, and which kind of also borders on asset allocation as the key determinant of how people should approach debt. Is that how you would want to start this conversation?
That's right. So one simple way to look at the allocation across debt would be go back to your needs and see, what's the spread of the risk or the type of, the type of objectives you have for your debt allocation. Now, we think that a simple way to do it without overcomplicating is to divide your debt allocation into 3 buckets. We call it the 3-lens framework. So you see that in my background of, 3 lens. The first lens, the first bucket, should be around your liquidity needs. This is important for every investor to have a proper set aside, which is easily accessible, is not exposed to a lot of risk, which is typically for your emergency needs or for just passing by or keeping some extra cash surplus, etc. Really a replacement for a savings account in some sense. And that's where your overnight funds and cash funds come in. So very low risk, very high liquidity. It's a just parking spot. The second bucket, which should be the core or the largest part of your debt portfolio, which is what we call the core bucket, is an area that we think you should not be taking a lot of risk. So this is an area where, keep in mind, the purpose for debt for most customers is safety. It's to try and earn a reasonable return without taking too much risk. So if that's the objective, it's very important to be able to go towards the highest quality of assets available. Therefore, don't take credit risk in that bucket and keep the duration short to medium in line with your objective. So if your objective is to keep money for 6 months, then that's the type of product without taking too much credit risk that you should go for. If your objective may be slightly longer, maybe 2 to 3 years, then you can choose that duration of products. But the underlying principle should be you match duration with your investment horizon, and you keep credit risk the lowest possible. And that's where we offer a whole bunch of our products, which are absolutely the top quality in terms of either being AAA oriented or higher or sovereign, essentially. So we don't take credit risk in this core bucket of products, irrespective of the duration. The third bucket, which is what we call the satellite bucket, is where you can now introduce a bit more risk. So this is an area where you say that, okay, for some part of my debt allocation, I can afford to take risk because I may have a longer holding period, or I want to play the cycle. So the two risks that you can take there is, one, you can take higher credit risk if you believe that the spreads available are more attractive today, or you can take a lot more duration risks if you think that the cycle will be in your favor, or the risk adjusted or duration adjusted sort of rate available is very attractive. So that's the place for you to take risk. I think often we get confused between these buckets when we don't think about it this way. So if we take credit risk and we place it as the largest or core part of our holding, then there's a bit of a mismatch in our minds. And that's something that most investors should try and avoid.
Okay. And you're clearly saying that when it comes to the core portfolio, the core bucket, which is effectively the reason why you are investing in debt, invest for all factors like safety, liquidity, and relatively stable returns as well. They may not be absolutely stable, but relatively stable returns.
That's right. And again, it's all about also, what you expect, what's your risk appetite, how sophisticated you are, etc. This is a framework we think that for most, normal investors should work. Because like I said, most normal investors are not really chasing that extra 10, 15, 20 basis points. They really want principal security first.
That's true. Vishal, just a quick follow-up before we get to the framework as well. And I thought that was pretty interesting, this whole the period for which you invest and the kind of funds that people can use. But just one quick question. There are some people who argue that when you're investing in debt, just use it for absolute safety. Don't take any risk, because if you want to take risks, you anyways have equities to play with. So why take any kind of risk in your debt portfolio? How would you, and of course it's very subjective and it's fairly behavioral, but I'm still asking for your personal view. What would you opine on this?
I don't think, it's too bad to not take any risk in debt, in a sense that, if it's a certain allocation or a certain proportion of your allocation, then, it can offer you reasonably attractive returns. We have to keep in mind that in different parts of the cycle, debt can actually outperform equity as well. It just depends on what part of the market or cycle you're looking at. So it's just about being conscious about what's your allocation in it. Right? So, when we look at equity, a lot of advisors, a lot of people will say that don't over-allocate it or over-allocate into a thematic or a high-risk strategy. It's similar here. It doesn't mean that good risk-adjusted returns cannot be had, provided you go about it very methodically. So why are you chasing it? How much risk can you bear? And if there are some shocks, and keep in mind, some of these shocks tend to be volatility, which is intermittent. Over a longer period of time, they may actually balance out. So if your holding period is adequate, because you did not need the liquidity and it was a smaller allocation, it can actually pay you quite handsomely also.
Okay. And therefore, you kind of done this debt allocation framework as well, wherein for the three buckets, liquidity, core, and satellite, you kind of distributed it amongst the different time frames as well, and what kind of funds could fit into these, Vishal?
That's right. So for our fund houses, for example, this would be available to all our partners as well as investors. Around, if you look at a product, we will have a label whether this is a core bucket product or is a satellite bucket product. So it makes it easier for you to decide, it's a liquidity bucket product. So you don't necessarily have to get too confused about the name and duration and looking under the hood in a very detailed way. You can just look at the label and try and figure out that this is generally going to have this strategy. It's also then important to stick to that. So even when, it does look like it gets very, very lucrative to to chase one part of the market. It's very important then to stick to that principle.
Yeah, sure. And viewers, keep in mind, I mean, this framework could actually be useful for you, not just at the risk of saying this while Vishal is on the show. These need not be only for the IDFC instruments. You can, if you believe in this framework and if you believe in IDFC's work, then you could actually use this framework for almost all of your debt instruments, the debt investments, even the existing ones, should you wish to swap or otherwise. Now, Vishal, I want to draw the conversation to the second topic, which we've, of course, told viewers that we'll talk about as well. And where does it fit within this allocation framework, which is target maturity funds? What are these funds? Why are they important if they are? And where do they fit within this debt allocation framework?
So firstly, the target maturity fund, as the name suggests, it has a target maturity. And which means that it will come to an end on a certain date, unlike a open-ended mutual fund, which is indefinite, right? So like in our case, we have two funds. One ends in 2027, one ends in 2028. So it's a 6-year and 7-year to maturity. In some sense, you can think about it like a quasi bond, which gets matured on a certain date and gives you back the NAV on that date. Right? It's not principal. This is obviously accumulated benefits as well. So that's one. The second, in our product, what we've done is that we are going to invest according to the CRISIL Gilt 2027 and 28 index. It means that the investment will only be in gilt, which by definition means that it's the highest quality of debt available. So we are not taking any credit risk of any kind in this fund. It's a very simple one where you just, it's almost like buying a portfolio of gilts and holding it to maturity in 2027 or 28, depending on the 6-year or 7-year product that you chose. Now, what's the benefit to you as an investor out of that? The first is, like the quotation on a gilt, the index also today will give you an implied yield. So the index does have a yield. So you have some better visibility on what your likely return could be if you held on to maturity, right? So if, for example, if the first of these funds has, let's say, a yield, or the index has a yield of, let's say, 630, then if you hold on, the fund manager will get 630 if you hold on till the end, less expenses, right? So that could be the type of return in a ballpark sense that you could expect. There are some leakages in terms of replicating the index or reinvestment risk, etc. But this is some variation you will have, but it's a far better visibility than many other funds. And I think you have, through your investors, would have seen that variability in returns can be quite high across many categories of debt funds also. So this reduces that variability if you hold on to maturity.
Okay.
Right. Just moving on to some of the other benefits of a mutual fund, like any other bond, or unlike many bonds where you might struggle with, how do I come in, how do I get out, etc. End of the day, this is still an index fund. And like any other index fund, you can come in and go out whenever you want. So while, of course, the benefit would accrue to you through the YTM or through the visibility that we're talking about, if you hold to maturity, nothing stops you from coming in or going out in between, because it employs the very convenient platform of a mutual fund or an index fund. Because it's an index fund, it's a relative passive strategy. It's also very low cost. So if you look at this and compare this to the actively managed products or the more complex products, in a sense, it's a very cheap or very cost-effective way of holding to a high-quality basket of government securities, G-Secs and T-bills, holding it over a period of time, having reasonable visibility on the returns, which is excluding the cost, and therefore lesser amount of, in one sense, volatility around how things are working or not working.
Okay. Vishal, a couple of last questions. One, is there any element of risk to this if a person is not wanting to hold it to maturity simply because rates in all probability might move up over the course of the rest of the year? They may not, we don't know. But if indeed one believes in this hypothesis that rates are going to inch up, is this the opportune time to go in for an investment like this, or should somebody wait it out a bit?
Right. In fact, Niraj, to be honest, we are launching this product now because we think there is a specific opportunity right now, which makes this type of a product very attractive or relatively attractive. The opportunity is that, and I'm sorry, I'm going to get into a bit more technical, but keep me honest here. The yield curve today, which is just how interest rates are spread out across different tenors, is extremely steep. So if you look at very, very near-end rates, overnight or 1 year or 2 years, these are very low on a relative basis. They've fallen a lot over the last couple of years. But as you go into the 6, 7, 8 year maturities or that sort of tenor, they have not fallen as much. Therefore, they are well anchored even today. So if you look at, for example, how rates have moved over the last, let's say, couple of years, the 6, 7, 8, 9 year bucket have not moved down as much. The 1 year or less bucket has moved down quite a bit. So it's very steep. So what you're effectively doing right now, is benefiting from that steepness. What that steepness also implies is that this part of the market, which is the 6, 7, 8 years, because it is not moved down, one may argue that even when potential rate hardening happens, the reverse happens, which is the short end or the 1 year or 2 years or 3 years may move up a lot more than what never fell as much. So it's a reversal of that rate, which means that in some argument, the rate risk or the reversal risk over here may be lesser than at the shorter end. The second is that you're also looking at your opportunity cost of what's the alternative and how does this compare to the alternative. So let's look at it like this. A lot of people would today, who want to invest for 5, 6, 7 years would choose, let's say, a fixed deposit. Now, if you compare this to a bank fixed deposit, these are typically offering you between 5, 5.5%. And keep in mind, interest is fully taxable there. Here, you may have a higher yield. Like I mentioned, the current index yield is in the 630, 640 region. You do get the benefit of indexation on funds. So post-indexation, assuming inflation being 3, 4, 5%, you take your pick. The net post-tax return to this could be significantly higher, is the other way to look at it. The third is that your alternative, like you mentioned, could be that I keep my debt investments in the short end and I wait for some rate hardening and then I switch to the medium to long end, right? When you do the maths around the differential, in our belief, that rate hike or some amount of pricing is already built into the current yield. So keep in mind, the short end rates are really 3 to 4%. So even if they go up by 100 basis points, if you do a simulation, and which I'm sure sophisticated investors will do, and a lot of our partners will help customers with, the net return from this, even after taking any mark-to-market adjustment, may still be more attractive. So we think that the yield curve today offers a very, very attractive position for 6 and 7 year yields. And that's the reason to structure this type of a very innovative product. This is the first gilt index fund, and offer it to the market in an index fund platform. It makes it convenient.
Well, okay. I hope that people take advantage of these options, depending on the risk appetite, of course, and depending on how much you understand this. Viewers, I urge you, if you don't understand this, try and listen to this whole conversation again. And even if that's not enough, then maybe consult a financial advisor if you wish to, before you go out and do this. But yeah, I mean, some of these options that are coming out right now and the innovativeness around some products is pretty heartening. And Vishal, I thank you for joining in today and taking time out to explain this in some detail about how people can go about doing this.
Here's one quick additional point I just want to highlight the benefit of your viewers, which is unique to target maturity plans, is that we have to keep in mind that because it's target maturity, the maturity or the tenor of this product keeps coming down over the next few years. So it's in that sense what is called a roll down maturity, right? So if you, let's say, holding it for 2 years, the residual maturity, which also represents the risk on the product, the duration risk on the product, is now no longer 6 years, it is 4 years if you originally bought the 6 year product, right? So as you keep holding on longer and longer, the duration risk or the sensitivity to interest rate moves is actually coming down in this product. So that's the other benefit that investors can use in a product like this. Like I said, it has many things packed in, although it's very simple to invest into because it's an index fund. But a lot of these uniqueness, I think, makes it very interesting for a specific market opportunity today.
A simple question, Vishal, but I'm guessing it's all the benefit of indexation would also come in for somebody who holds on, right?
Absolutely. So even if you hold on for 3 years, the point is that you bought a 6-year yield index fund, you held it for 3 years. If you invest before March, of course, you may have an additional indexation, year that you can avail of. And at the end, depending on where the price is, yield is, it may have moved up or down at that point in time. The entire point is that the residual maturity at that point is only 3, the balance 3. It's not full 6.
Yes.
So any mark-to-market risk at that level is not as high as it might be today. And therefore, it's always coming down.
Pertinent points all. Vishal, all the best with this NFO. Thank you so much for, as I said, taking the time out and explaining it to us and this whole debt allocation framework. I'm sure it's very useful to me as well and to viewers too.
Thanks for having me. It's always a pleasure.
The pleasure is ours. Thanks for joining in. Well, viewers, that's the view from IDFC Mutual Fund, debt investing and how can you go about doing it. And of course, a slight segue into target maturity funds, a couple of which they are coming out with as well. And maybe in some fashion that would help you try and analyze what to do. Now, if it was difficult, let's try and see if we can get in somebody who you would believe doesn't have a biased view, because you may believe in all fairness that Vishal Kapoor, since he's the MD and CEO of that firm, might actually come out and say good things about the fund, naturally. So let's get in Harshad Chetanwala. He joins us for the first time on the Mutual Fund Show to try and talk about this and then a couple of other things as well. Harshad, really good having you. Thanks for joining in. I hope all is safe. I don't know if you got a chance to hear what Vishal was saying, but if you did, what is your view on target maturity funds in general? And if you've looked at this upcoming fund offer, what is your view on that as well?
Sure. Niraj, thanks for inviting me. It's a pleasure to be here for the first time. Okay. And I'll try to put forward the views, as you said, as in the unbiased manner. Okay, which helps the audience to understand this, not just this particular fund, but there are a few important points which I think Vishal did cover in his conversation. I think one of the things which I really liked was the bucketing strategy which he explained. Okay, yeah. And I think it's not just the bucketing strategy for debt investments. That strategy actually we use it for a lot of our retired investors. Okay, so very interesting point on that. So I'll quickly try to put forward my views on the NFO one, and of course the target, on the target maturity fund. So right now the view is that at present the interest rates are low, okay, and the interest rates are expected to increase over the period of time, which I think you also covered in your talk with Vishal. Okay, and that is where one thought of in our mind is that it doesn't make right now sense to go and block the money on a long-term debt instrument, okay, which has a long-term maturity. Okay, so right now what we are trying to put forward to investors is it is better to be in short duration, ultra short duration, or maximum a bit of medium duration, where the maturity is between around 1.5 to 2 years.
Mm-hmm.
This is purely from the interest rate.
Just explain why.
So in a very simple manner, let's say that the interest rate tends to, right now the interest rates are low. Okay, if in case I invest into instruments or long-term instruments right now, okay, in a way the interest rates are locked for these instruments. Tomorrow down the line, if the interest rate goes up, the interest rates and the price of the bond are inversely related. Okay, so as the interest rate goes up, okay, the price of the bond which I'm holding right now, which I've already invested into, the price will go down.
Yes.
Okay? And when the price goes down, it has a direct impact on my NAV because the value of my portfolio goes down. Okay, so from that perspective, okay, we are trying to put forward that it is better to be in a ultra short or a medium duration debt investment.
Harshad, may I ask a question, because a viewer would try and think that if the price of the bond in the near term is going to come down, shouldn't I rather invest in the longer term scenario, because I'll hold it till then and therefore the market will even out by then. If I'm buying a short term fund right now or a shorter duration fund, then the price of the bond will come down, and therefore the NAV will come down, and therefore when I have to exit, it could be a problem for me?
So I'll tell you. So what happens is, okay, that let's say I want to enter. So you're entering into the product. Okay, so like take a classic example of the product which I think Vishal did touch based on. Okay, and let's try to club both these in a way. Okay, because they are linked in a way. Okay, so now we are talking about a 6.5% or a 6.3% kind of a return from this product before tax. Okay, now this is based on the current interest rate. Okay, of the products or the avenues where the investments are going to happen. Let's say down the line the interest rate goes up. Okay, so the new papers that are going to come, the new bonds that are going to come, are going to offer a higher rate of return. Okay. So what is going to happen? Let's say that they start offering 7% return, for example, and just hypothetically.
Sure.
Okay. So that 6.3% return. Okay, and let's say the paper cost is 100 rupees or the value is 100. Okay, I have to, the price of that 100 rupees will go down because it's just offering 6.3 or 6.5 vis-a-vis 7. Okay, so that's why right now in current scenario, okay, where we expect the interest rates to go up, because RBI has been tremendously tolerable looking at the from the recovery perspective. Okay, so from all these reasons, okay, it may make sense, okay, to look at medium term to short term. But having said that, this product is I really like the product in a couple of manners, very very frankly. Okay, so one is it takes away your credit risk because it's going into G-Secs. Okay, while the duration is around 5 to 6 years, that's what I've understood.
No, but Harshad, my simple point is sorry, you just very quickly, because we spent inordinate time on this, but just very quickly. Therefore, my question is, why should I buy into a short-term or a shorter duration fund right now? Shouldn't I rather buy?
So because I wait for the opportunity. Okay, so when the interest rates goes up, because the fund manager also have the opportunity to go and buy, okay, or take the bonds which will give you higher yield. Okay, and that probably is the time. So it's very difficult. Like we say in equities, it's very difficult to time the market. Okay, it's also similar in the debt market, because the interest rate risk will always be there.
Of course,
will always be there.
Okay, There's one quick question, Harshad, then.
Yeah.
How does this compare, for example, to some existing product like, loosely put, the Bharat Bond ETF, which has got, let's say, a 5-year horizon. So you hold it for 5 years. It holds high quality government securities, and it's an ETF, and they talk about it as being low cost. Target maturity funds, and Vishal spoke about this being a low cost as well. So how does it compare to something like that? Because an investor has both the options.
So I think these are very good instruments for conservative investors who do not want to.
Is one better than the other?
So I would say, I would rate them together, very frankly. Okay, because the nature of the investments is very nearby. At the same time, the returns that you will expect from both these kind of investments will be very close.
Got it.
Okay. So I would rate them very close to each other.
Okay, fair call. Thanks for being frank, Harshad. Now, let's talk about a couple of other things. We've spent so much time on these, but let's try and discuss the other two topics as well. Viewers, remember, every show we ask our advisor or expert to come in and talk about one category which has stood out and a fund within that category. And Harshad, what is it that, before we get to your fund recommendation, what is that category and what is that fund within the category that you want to talk about? Is it a well-performing mid-cap fund? Is it a least performing large-cap fund? What is it that you've chosen, and what is the fund within that category?
So there are basically 2 points that I'm trying to put forward. Okay, the first one is the category which works for most of the investors. That is the flexi cap category, which was earlier known as multi-cap. Okay, so that's a category which do take a lot of allocation at our end when we work for our clients and when we work for their portfolio. Okay. And this is predominantly is for long-term investors who are looking for their financial goals right from 5 years and above or 7 years and above. So flexi cap funds are good because, in our view, it gives the option to the fund manager to invest into large caps, small caps, and mid caps in a way. Okay, and the fund manager do have this flexibility to take the call depending on the market conditions. I think this makes this makes a much more easier job for the fund manager. At the same time, for us who are advising the client, okay, we have to identify the right kind of flexi cap funds and then rely on the fund manager to deliver the returns. Okay. So if we look at that category, okay, there are very good funds which have been doing very consistently well across these years. Okay, So one of the fund that we have identified, okay, is UTI FlexiCap fund. It could be an unusual choice, okay, but I think this is based on what we have been researched, the kind of research that we have done on the fund, okay. This fund has been one of the most consistent or the best performers in recent times in the FlexiCap category. Okay. While we are not inclined much towards the size of the fund, but from a size, people who look at the size of the fund, it's a reasonably, it's a very good, fund size. If you look at around 15 to 16,000 odd crores is the size of the fund. I think another important point that we looked into this fund is this fund have quite well diversified across different sectors. Traditionally, if you see, most of the peers of the fund will be, will have, of course, the highest allocation will be in financial most of the time. Okay, barring I think Parag Parikh, where the technology is the highest sector. Okay, but most of the time you will see that equity-based, equity-oriented, diversified fund will have a higher allocation in financial sector. Okay, this particular fund also have a higher allocation in financial, but the spread is quite well. Okay, so you have financial close to around 25% or 26%. And then you have healthcare and technology and then services. Okay. So well diversified across sector, one. Okay. And the fund is not trying to be overweight on a particular stock. Okay. So if you look at the top 5 stocks, okay, it will be around 25% of the portfolio.
Okay.
Okay. And from a it's very important for us to look at the fund in a rising market at the time of, and as well as the falling market. Okay. And the year 2020 gave us the opportunity to look at both the sides, right? Yeah. Okay. So when you look at this fund at the time of, let's say, right from, let's say, 17th of Jan to 23rd of March, which was the falling phase, and then the recovery phase, okay, the fund has done quite well. It will always be in the top top quartile kind of within the peers.
Is it better or worse than some of the others available? Because when I hear of FlexiCap funds, I typically hear of Parag Parikh or Mire are doing very well. So is it better or worse than the others? Or why have you chosen this over the others?
No, so it's not. I have chosen over the others. Okay. So one of the thing is whenever we put forward FlexiCap, we'll always have 2 or 3 options. Okay. So let's say a typical investor, if in case we are constructing a portfolio for the investor, okay, we look at around 6 to 7 funds.
Okay.
Within 6 to 7 funds, there will be an allocation or 2 or 3 funds into FlexiCap. So this is one of those, because I presume that earlier speakers would have covered Parag Parikh and Mera and all. Okay, and I see there's a lot of merit in covering this fund also.
Okay, fair call. So cool. So you believe that if investors should look at the FlexiCap category, and UTI FlexiCap fund would be amongst your preferred names for the reasons that you explained. Now, if I'm choosing not to give you a particular category, but just one fund recommendation amongst the plethora of one available, equity side, of course, which one is it? Why? And what kind of investors or what kind of clients from your clients that you have are you recommending this fund for?
So, I would say on the equity side, okay, while, if I have the choice, I would have said, Mirai Asset Emerging Blue Chip, but unfortunately that fund, okay, only takes SIP up to 2,500. Okay. Then I would go back to, the usual talks about Parag Parikh, FlexiCap. Okay. And I may also have an option of adding Mirai Large Cap Equity Fund. So these are the 2 funds which which do come under our recommendation when we try to construct the portfolio for our investors. Okay. I think most importantly is not just how consistently they have performed, but also how they have performed, including UTI FlexiCap, how they have performed during a good phase of the market and the bad phase of the market. That shows the quality of the fund management and the stocks that they hold.
Fair call. Okay. Well, Harshad, this was insightful. Thank you for giving us a sense of the fund offering from the IDFC side. Really appreciate your views and some pretty interesting thought on UTI FlexiCap fund as well. Thanks for taking the time out and speaking to us today.
Thank you. Thanks, Niraj.
And viewers, thanks for tuning into this leg of the Mutual Fund Show. Earnest request from all of us at BloombergQuint: stay safe and please wear your masks.